Everyone. Thank you for joining us for our year-end planning and tax update. My name is Gigi G. I'm a certified financial planner and a partner at PKS Investment Advisors. I'm joined by my esteemed colleagues, Doug McCabe, CPA and Esquire and partner, as well as Emilee Snader, CPA and manager at PKS Company. We're going to go ahead and get started. First, I have to, of course, we got to follow compliance. Please see our disclosure. PKS Investment Advisors does not provide any tax advice or legal advice. We recommend that you consult your trusted tax advisor or legal professional before acting on any of the suggestions during this presentation, and that this presentation is for educational purposes only. If you don't know us, a little bit about us, I'm going to talk a little bit about PKS Investment Advisors and PKS Company, the accounting firm. Two separate firms, but all under one roof, where we marry and work in lockstep together, the tax planning and financial planning together. PKS Investment Advisors is a fee-based, independent registered investment advisory firm focused on providing holistic financial planning and adhering to the fiduciary standard, which is simply putting our clients' best interests at all times ahead of our own. We provide comprehensive financial planning and retirement planning for investment management for businesses and individuals, including retirement plans. PKS Company is a full-service accounting firm that was started in 1978. It provides traditional accounting for individuals as well as businesses, and also provides retirement plan audits, administration, business consulting, litigation support, as well as payroll services and forensic services. PKS Company specializes in multitude of industries, including healthcare, agribusiness, hospitality, and government. We have in-house certified business valuation services, as well as fraud examination and retirement plan administration. We have 3 locations: West Ocean City, Salisbury, Maryland, as well as Lewis, Delaware. With that, let's get started with the year-end tax planning and last-minute financial planning updates. The goal of today's presentation will be to review any financial changes that might have occurred in your life over the last 12 months. We will be sending out this last chance financial planning checklist via a link post-webinar, so that you will be able to use it for your own personal use, as well as work with your advisor, your tax advisor with this checklist. We're going to go through several different sections on the checklist, 8 different areas of last-minute financial planning. But before we get started, just a couple housekeeping items. We will hold questions to the end of the webinar. And you could use the Q&A feature, which is to the right of to the bottom of your screen to the right. You'll see a Q&A. If you could post your questions there, we will definitely get to those at the end of the webinar. So the last year might have brought many unexpected changes to your financial life that you might not even think that they are a change that you need to consider. You might have decided to retire early, or unfortunately lost a job, or sold your home in that last year. Even if you've not made any major financial changes, it's important to review the entire financial picture to make sure that you're not missing any opportunities for this year and next year. So we're going to go through 8 different areas of a financial picture of financial life. So let's start with taxes. With the proposed tax changes on the horizon, I'm sure many of you have questions. And again, we direct you to the tax advisor, the professional tax advisor. This by no means is tax advice, but it just points out areas that you might want to think about or discuss with your advisor. Project your income. What's your income going to look like by the end of this year? Also, maybe be able to project what your income is going to be like for next year, to try to plan which year to take maybe some capital gains or some losses, or maybe do a Roth conversion. If your income is lower this year, it might be worth considering a Roth conversion rather than next year if you expect higher income next year. Review any opportunities for tax loss harvesting in your investments. That's where you sell for some loss to use against your income. Make sure you have all your cost basis information on your securities and your real estate, and check any carry forward losses. Review any planning in light of the Tax Cuts and Jobs Act, which Emilee and Doug will talk about later. And then also make sure you have all your deductions and credits lined up for this year and for next year. Next up, we're going to talk about retirement. Retirement comes with a lot of decisions, right? Whether you're just retired or you've been retired or you're approaching retirement, there's all these kind of considerations. So let's talk about your retirement plans. We want to make sure that you're looking at the opportunity to max out your 401k or retirement plan contributions, including catch-ups. Now is a great time of year to consider increasing your deferrals 1 to 2% because they can make a really big difference in your retirement assets by the time you retire, between the increased, hopefully in your income, increased deferral, also the compounding interest that comes with those investments really can make a huge difference. Max out your IRA contributions. Check with your tax advisor to make sure you're able to do a Roth contribution this year. That's based on your income. You might be limited. So maybe if you're not able to do a direct Roth contribution, it's worth considering a Roth conversion. Again, there's a difference here as far as when you can do a Roth conversion versus actually making an IRA or Roth contribution. While you can delay your IRA or Roth contribution to your tax filing deadline in April of next year for 2024, you cannot do that with a Roth conversion. Roth conversions need to be done within the calendar year, so no later than 12/31. And then also make sure you've done those required minimum distributions if you are of that age. It's a little late to open a new retirement plan at this point. However, maybe you want to look to see if you could do a SEP if that's something that makes sense for you. And then check the status of all your retirement accounts and make sure they're invested properly. Another thing is to consider your Social Security claiming options. Those are some services that we provide to our clients if somebody wants an analysis to make sure that they are choosing the right age to claim their Social Security. We can help them with that. This year, retirement plan contribution limits, 401ks, just to go over the checklist real quick to make sure you know what your deferral limits are. 401k is $23,000. If you're over age 50, you get the added benefit of deferring $7,500 extra dollars to help you be more successful in retirement. Simple IRAs, elective deferral limits are $16,000 this year. And then the catch-up is $3,500. Now, here's something that many people don't know. For employers with less than 26 employees, the Secure Act did provide an added, increased deferral limit for simple IRAs. For only smaller employers, $17,600 is the deferral limit, and then $3,850 for the catch-up for anybody over age 50. Roth and IRA contribution limits are $7,000 under age 50 with a $1,000 catch-up for 50 and old. Next up, we're going to talk about investments. When you're discussing this when I'm discussing this with my clients and you're working with your advisor, you need to think about the questions you might have about your investments and the risk and the allocation you have at the time. You want to make sure that your investment strategy lines up with your goals, reviewing any outstanding loans or mortgages, re-examine and revisit your income and savings needs. And also, not only are we going to talk about asset allocation, right? How much risk you're taking in your investments. Let's talk about how much we can help with asset location, which simply means we're looking at the portfolio as a whole and making sure that those tax efficient investments are in the taxable accounts and the tax inefficient investments are in the tax deferred accounts like IRAs and Roths, right? That really can make a huge difference in your tax efficiency and your overall after-tax performance. Still, while keeping your actual risk and your asset allocation in line with your investment goals. Next, we can talk about insurance. Nobody wants to do this, but it really is important. Nobody likes to look at their insurance policies and review them for their limits and how they're covered. But it really is an important step to make sure that you are insured up to where you need to be insured. And that is working with your qualified insurance agent. Review your property and casualty policies, because maybe you've improved your home. Maybe you did some renovation and it's going to increase the value of your home. You want to make sure that you consult your insurance agent to see if you need to increase your coverage. Make sure that you also have the proper coverage. If you want replacement costs for your home, you're going to have to make sure that you have the right coverage there. Also, was there any changes in your business or your financial needs? Maybe you need to look at your umbrella policy. Make sure you have an umbrella policy. Is it time to consider increasing your umbrella policy? Do you have a teenager who's driving that lives at home? You know, maybe that's a reason to consider increasing your umbrella policy. Review your health insurance coverage and identify any material changes that you might need to make. And especially always review your beneficiaries. And that includes your beneficiaries on all accounts, your investment accounts, your retirement plan accounts, IRAs, Roth IRAs, every single thing that you have a beneficiary named on, make sure they're all in line with your wishes. Another thing you'd want to discuss with your advisor is, did you reach any milestones within the last year? So if you're in that box of age 50 and older now, you can make that extra catch-up contribution, which I just went over those limits. Also, if you're 55, you can take distributions from your 401ks without penalty if retired. It's called the rule of 55. There are some rules to the rule of 55, so you need to make sure that you consult your tax accountant or your advisor to make sure that you're following those rules. For instance, it has to be in the 401k plan from which you retired at that employer. It cannot be rolled to an IRA if you don't want to have that 10% tax penalty applied. 59 and a half, you can now take distributions from your IRA without penalty. 62 to 70, you consider taking your Social Security. I never recommend taking Social Security before full retirement age unless there's a special circumstance. But again, that's something we help our clients with. We analyze their Social Security statements to make sure that we're planning the best Social Security claiming strategy for them. And then 65, you can apply for Medicare. 73, you must have started taking your required minimum distributions. But one note is qualified charitable distributions. Actually, you can start those at 70 and a half. Healthcare is another area to review each year. Here are some actions you want to take before the end of the year. Review your employer's health insurance plan to make sure that the coverage is sufficient for you. Review your Medicare enrollment and your health savings account this year. So Medicare enrollment has, not that has changed, but Medicare Part D. Pay special attention to any changes to prescription coverage. With the Inflation Reduction Act, there have been some improvements and changes to Medicare Part D. If you didn't catch our previous webinar where Alyssa Sadagra from Avery Hall talked a little bit about those changes, I encourage you to go to our website to watch it to see if there's anything you need to consider, but I would urge you to consult a Medicare specialist if you had any questions on how those changes might affect you. Talk about family. Maybe it's time that you're thinking about gifting to your children or grandchildren's 529 plan. Make sure you get those contributions in before the year end. Review and fund your trusts. I don't know how many times I've had clients and prospects work with an attorney and they have this beautiful trust document created that they're ready, all their wishes are laid out, and they come to me and I'm like, okay, so what is in the trust? And there's nothing. It's really something that I think many people don't understand. Just because you draft the trust document doesn't mean it's funded. You have to re-register properties into the trust name to actually be following the trust. Make any cash gifts to family members. The $18,000 is the annual gift tax exclusion this year, so $18,000 per person. And then plan any charitable contributions you want to make before the end of the year. So the years bring many changes for everyone, whether it's a job status change, relocation, or even losing a loved one. Unfortunately, these are all important financial changes that could affect you and your financial picture and your planning this year and next year and in the future. So consider every single one of these questions. Did you end a marriage? Did you get married? Did you move? Did you change jobs? Are you taking care of any elderly parents? These are all things you want to consider for your financial planning because it might make a difference in your picture. So to wrap up, the last chance financial planning checklist, just think about any other changes that might be important for you in your planning for 2024 and beyond. And feel free to reach out to us if you have any questions or if we can help go through that checklist with you to see if there's anything we can do to help. With that, I'm going to hand it over to Doug McCabe, who's going to talk about estate and gift issues.
Okay, good afternoon. Do you want to switch it to the next slide, somebody? Okay, good. I'm going to talk a little bit about a couple of aspects that have to do with estate taxes as well as estate planning. And one thing that I want to touch on right off the bat is the current federal estate tax exemption. Currently, in this year, 2024, the estate tax exemption is 3.61 million, and it's going to go up next year in 2025 up to 13.99 million. Call it 14 million. One thing that could happen, and Emilee will probably talk about it a little bit more later, is that a lot of aspects of the current income as well as estate tax system that we have right now, they are scheduled to actually sunset in 2016, and that means that those rules would go away and be replaced to the rules that we had prior to 2018 when the current estate and income tax laws came into effect. So what does that mean for estate tax exemptions? Well, the 13-ish million exemptions that I just told you about will actually revert back to the old rules prior to 2018, and that estate tax exemption will be adjusted for inflation, will be somewhere around 7 million. So for higher net worth people, 2015 or 2025 will probably be a very good year to make gifts, because there is a provision in the rule that says that any gifts that were given between 2018 and 2025, while the exemption is high, will be excluded from the donor's taxable estate when we drop back down to 2026's, when this provision sunsets, and we potentially drop back to the 2017 exemption, which is about $7 million, which I just discussed. So, of course, we don't know what's going to happen tomorrow in the election, and that will have some influence on what ends up happening with this. It is quite possible that this current tax system that we have right now will be extended. It's also possible that it will be completely replaced with something different. But if nothing happens, then it's going to revert back to the old rules. And that's what we're going to have, the old rules being the rules that were in place in 2017 and prior. Now, Gigi touched on it earlier. The annual exclusion, essentially what that is the amount of money that you can give away to as many recipients as you would like, individual recipients as you would like, and in trust as well in certain circumstances, that you can give away without having to tell the IRS or anybody that you've done it. And the annual exclusion, which is also known as the gift exclusion, is in 2024 is 18,000, and then in 25 it's scheduled to go up to 19,000. So that's the amount of money that you can give away and not have to file a gift tax return or tell anybody that you've done it. And that is per recipient. So if you have 3 children, You can give all three of them $18,000 during the year and not have to report it to anybody. If you're married, then the two spouses together can give away $18,000 each, $36,000 total, to as many recipients as they would like to, without having to tell the IRS anything. If you go over those amounts, that's not taxable per se. Then we just start eating into your lifetime exemption, which currently is about 13.6 million in 2024, and then it's scheduled to go up to close to 14 million in 2025, which then could revert back, unless we get a new tax law in 2026, back down to 7 million. As I said, the gifts that are made from 2018 to 2025, while the estate tax exemption is elevated, will not count against the taxpayer in 2026 if this rule does end up sunsetting and going away. Maryland, for those of you in Maryland, Maryland has an estate tax exemption of 5 million. And Maryland does not have any plans to adjust that threshold. So if you're going to, if you're in Maryland and and you pass away, and your inheritance, that your estate, better way of putting it, your estate is going to be inherited by somebody other than the spouse, or other than a charity, and it's going to go, let's say to children. That is when these estate laws kick in, and Maryland will tax the estate over 5 million. The federal will not tax it until over, unless the estate's over 13.6 million. The federal estate tax rate is 40% for anything that's taxable over the 13.6 million currently. And Maryland's estate tax rate is 5 million. I'm sorry, is 16% over the 5 million. Again, bequest, states going to spouses are not subject to estate tax, as well as the estate portion, if it went to a qualifying charity, would also not be subject to estate taxes. All right, probate. I'm going to talk a little bit about probate. And then I'm going to also talk about a little bit about some ways to avoid probate. Now, first of all, what is it? Probate is essentially, it's a court-observed process to administer a decedent's estate when they pass away. Couple things that happen here: if the person, the decedent, died with a will, the court will look at the will to make sure that it's valid. That's part of the process. Also, a personal representative, also known as an executor, will be appointed. Typically, that's done within the will. If there is no will and the decedent died intestate, then you look to state law as to who is going to be the personal representative, or also known as an executor. Big part of the probate process is to advertise in a local newspaper and gather the mail of the decedent to make sure that they didn't owe any money. Mortgages, car loans, credit cards, whatever. Part of the probate process, a big part of the probate process, is to make sure that the decedent's creditors are paid prior to any heirs getting any money. So if the person dies with $100,000 worth of debt, they had $150,000 worth of assets. The $100,000 worth of debt will have to get satisfied out of that $150,000 of assets before the heirs get any money. Okay, so that's part of the process, probate process. Ultimately, what will happen is the assets, after all creditors are paid, the attorneys are paid, tax returns have been filed, and all the business of the estate has been finalized, the assets will pass to the heirs that are listed in the will, named in the will. If there is no will, then there's a state law that kicks in and says these are the people who are going to receive the money from the decedent's estate. In Maryland, it takes a minimum of 6 months to probate an estate, because under Maryland law, creditors have 6 months to come forward and present their claims, any claims that they have against the estate. So therefore, we have to keep the estate open in Maryland for at least 6 months. The average length of time to actually wrap up all the business of the estate, get court approval, and ultimately distribute the assets in accordance with the decedent's will, or under state law, if there is no will, usually takes about a year. So it's not a terrible process. There's paperwork and there's things that you have to file with the court. Generally, you hire the aid of an attorney to help you through the process, but it takes a while, and there is quite a bit of paperwork that also has to be filed with the court. So it takes a minute to go through the probate procedures, and there are ways to avoid probate, and that's what I'm going to talk about next. Ways to avoid probate is to actually retitle assets so that they don't have to go through that process. Now, what assets actually go through the process? The assets that go through the process are assets that are in the sole name of the decedent, where they have no mechanism on the title of those assets to automatically transfer those assets to somebody else upon their passing. So if you put transfer on death or payable on death, known as TOD or POD, same thing, same synonymous. They're synonymous, just different brokerage houses, different banks use, different language, but it's the same thing. If you put those designations on there, then those assets will not go through probate. They will go to whoever is named on those investments or bank account as the payable or transfer on death designee. So upon the death of the decedent, if an asset or a bank account has a payable on death provision or transfer on death provision, those assets avoid probate and go automatically to the person that is named. That is one way of avoiding the whole probate process and getting the assets to the heirs really quickly. Another way of avoiding probate would be any assets that you hold jointly with rights of survivorship. Tenants by the entireties, you've probably heard of that before. That's a typical way that a husband and wife or a married couple, spouses own a property or own an investment, and those assets will transfer to the surviving joint tenant upon their death. Joint tenants with right of survivorship works very similar to tenants by the entireties, but that joint tenants with the right of survivorship is assets that are held jointly with rights of survivorship between people who are not spouses, two or more people who are not spouses. In those cases, upon the person's death, it goes to the survivor. There's multiple people, it goes to the last person living gets the entire asset. But again, it's a way of avoiding probate. Those assets that are held jointly with rights of survivorship, either with joint tenants with right of survivorship or tenants by the entireties. In the case of a married couple, those assets avoid probate. Trust. Also, the assets that are held in a trust do not have to go through probate. They go in accordance with the trust document. In every single trust document, there is a provision in there of what happens to the assets that are titled in that trust upon the grantor being the person who created the trust, what happens upon the grantor's death. So in there it says when the grantor, who's the person that created the trust, upon their death, this is what happens to the assets. And again, the assets go in accordance with the trust document where they say that it goes. It does. Those assets do not have to go through probate. Beneficiary designations. You typically see these in retirement accounts or life insurance policies. Just simply, a beneficiary is designated in the paperwork with the retirement account or with the life insurance policy, And those assets again transfer to the named beneficiary upon the person's death. Again, doesn't have to go through probate. And lastly is a life estate, and you'll see this oftentimes mostly with real estate, which gives the person that created the life estate lifetime rights to use the property. A lot of times it's real estate to live in the property. It could be they might even have rights to sell it. In other cases, maybe they don't, depending upon how the life estate is written. But what happens there is the person has lifetime rights to that property, but upon their death, named in the deed, the asset goes to somebody, to whoever's named in the deed. And again, that's another way of avoiding probate. Couple little things that I just want to point out before I wrap up here. One of the best things that you can possibly do for your family is to take some sort of a notebook or a spreadsheet and put in there list all of your assets and who to contact, maybe your broker, your attorney, or maybe it's or a financial advisor, somebody in there of who to call about that particular asset upon your death, and list them all, with account numbers. You don't have to put the dollar amount on there. Nobody needs to know that until after you've passed away, unless you want to put the dollar amounts on there. But really, just I have an account, with Gigi LeKites. That's who you call if something happens to me. I've got real estate. Here's the real estate that I own. Here's the bank accounts that I have. These are whatever that I own, and put the description of the account, where it's held, a contact person, and an account number. That will make sure that no assets are missed upon your death. I had a situation once when we were probating in the state. I often talk about this. We had no idea that the decedent had $1 million life insurance. We were getting close to the end of wrapping up the estate, and we received a bill in the mail for the next year's premium. I had no idea that the decedent had $1 million policy. We called the number on, I don't remember who the life insurance company was, but nevertheless, we got the bill. We called the 1-800 number and found out it was $1 million life insurance, and it had named beneficiaries and everything else. But that asset almost got missed because nobody knew about it. The other thing that I just want to say, you've got estate planning documents like like your will. You want to make sure that you have it in a fireproof safe. You definitely want to make sure your original will is, because that's the one that gets probated. There is a way to probate a copy of a will, but it's a lot more difficult and whatnot. You want the original will when you go in to open up the probate estate. So you want to keep it in a fireproof safe. You want to keep it someplace secure. Many a times with an attorney's offices, the attorney that drafts it will keep your will in their safe. They will do that. Some attorneys don't do that. Other times, the person wants their will. That's fine. If you do want to keep your own will, you can either lodge it with the Register of Wills. You don't have to do that, but you can. Or you keep it someplace safe and secure. A lot of people want to use a safe deposit box to where they keep their will. Well, the problem with that is if nobody else has access to that safe deposit box, you actually have to get a court order to open up that safe deposit box upon your death. Why? You're the only one who has access to that safe deposit box per the whatever agreement you have with that bank, and now you've passed away. So there is a mechanism for opening up that safe deposit box if the decedent was the only one that had access to it. But again, you have to go through the court system and actually get a court order to do it. And nobody wants to have to go through that. So if you're going to keep it in a safe deposit box, make sure that somebody else has legal access to that safe deposit box, or You can keep the will at Register of Wills in the county in which you live, or you can keep it at your attorney's office if they offer that service. Or thirdly, you can keep it in a secure place, but make sure that it's in a fireproof box and somebody knows how to get to it, or fireproof safe and somebody knows how to get to it. Okay, that's all I had, I think.
Okay, now I'm going to go over some kind of general year-end tax planning strategies. So contributions to accounts and plans, and Gigi kind of already touched on this earlier, so I'm not going to go over in great detail the amounts. But if you're eligible to, contributions to retirement accounts, HSA accounts, and 529 plans are great ways to lower taxable income. Not only that, but they provide a means to save and grow your income tax-free. They do require an additional cash outlay now, but you will end up keeping more of your own money in the long run. I suggest contributing as much as possible to these types of accounts and plans. Of course, there are rules for eligibility and limitations on the amount you may contribute. But retirement and HSA account contributions directly reduce federal taxable income. 529 plans for college savings offer a state tax deduction in many cases. Not all states have a 529 plan tax deduction, but all Maryland, Delaware, and Virginia do. A Roth conversion, where you convert all or a portion of a traditional IRA to a Roth IRA, may be something you should consider. This is another strategy that involves an additional outlay of cash now, but can be a very effective planning tool. It's best for those who are in a lower tax bracket now that expect to be in a higher tax bracket during retirement. You can pay tax on the deferred income now at a lower rate and allow it to grow tax-free until retirement. This can help lower your tax bracket in retirement, since when the funds are distributed, they will not increase your taxable income. This may lower taxability of Social Security benefits as well, or reduce net investment income tax, which is another way to lower tax altogether. Consider harvesting gains and losses. In other words, if you are considering selling securities, you can take advantage of whether they'll be sold at a gain or a loss. You may want to sell at a loss if you have a large capital gain from sale of real estate or a business activity. But keep in mind that only $3,000 of net capital losses can be deducted against ordinary income per year. Any net losses beyond 3,000 will carry over to future years, but it kind of goes against the purpose of it. If you take this huge loss, but you don't have any capital gains to go against it, you won't be able to use it all. You may want to sell at a gain if you have capital losses from the sale of real estate or a business activity, and you have capital loss carryover, or if you have capital loss carryover from previous years. If you're planning to sell real estate and considering investing in more rental real estate, you might want to consider doing a like-kind exchange, which is also known as a 1031 exchange, to defer the capital gain. The gain won't be recognized as taxable income until you sell that exchanged property. There are strict rules to do so, and time limits to invest in the new property. You must identify the new property within 45 days of the sale, and the new property must be purchased or exchanged within 180 days. There's other considerations. Also, the chance you'll have to recognize capital gain in the year of sale if you have the following scenarios. You've paid off a mortgage with the exchange, cash is received on the exchange, or if personal property is received on the exchange, like furniture or a trailer, I've seen in some cases. So Doug talked about this a little bit. I'm not going to go into great detail, but that Tax Cuts and Jobs Act that took effect in 2018 really made the standard deduction higher, and it made a lot less people eligible for itemized deductions. But like he talked about, those provisions, a lot of those provisions are due to sunset, but not until the end of 2025, which is why I'm not going to go into great detail with it. Again, we really don't know if those are going to be extended, or depending on the election, depending on Congress, how much they're able to push through, if anything is going to be changing with tax law in general. But as for now, we know that these provisions are here until the end of 2025. So like I said, we've had much higher standard deductions than in the past. For 2024, the standard deduction is $14,600 for single filers, $29,200 for joint filers, and $21,900 for heads of household. With standard deductions as high, it becomes more important to have a strategy for whether you're going to itemize or take the standard deduction. It may be best to alternate taking standard deduction or itemized deductions every other year, so you aren't missing out on deductions. You can plan to maximize itemized deductions by bunching them in alternating years. If you have a medical procedure or expense that you have control over the timing of, you may want to expedite them before year end. Keep in mind that you can only deduct medical expenses over and above 7.5% of your AGI, your adjusted gross income. This means that many medical expenses go unused as a deduction because there aren't enough to get over the threshold, or there are, but still aren't enough other itemized deductions for them to be more than the standard deduction. You could also group charitable contributions, contribute 2 years worth of contributions every other year. So this works especially well for those that have that contribute like a regular amount to certain charities. Like we see it most with church, that people will contribute the same amounts over and over again. You might want to try to bunch that. If the standard deduction will be higher than itemized deductions, you can divert otherwise lost itemized deductions to be deductible in a different way. So lost medical expense deductions may be eligible to be deducted as self-employed health insurance if you're self-employed, or run through a health savings account if you have a high deductible health insurance plan. These could both be good strategies, even if you are itemizing, since, like I said, there may not be enough medical expenses to meet the 7.5% of AGI threshold. Real estate taxes and mortgage interest may be partially deductible as home office expense if you're self-employed. And charitable contributions may reduce otherwise taxable required minimum distributions of retirement accounts by doing a qualified charitable contribution or a distribution, which is, like Gigi spoke about earlier, is for taxpayers over 70 and a half. State income tax may be paid by a pass-through entity instead if you are an S Corp owner or partnership owner. So the PTE tax deduction. Also with the Tax Cuts and Jobs Act, that state and local income tax, the SALT, itemized deduction was capped at $10,000, meaning a lot of people, especially in high income tax states, have lost what could be a huge deduction for them. So many states have created a workaround for that, for pass-through entity owners to still deduct state taxes created by their S Corps and partnerships. You can elect to have the PTE pay the state taxes on behalf of the owners, instead of the owner paying taxes at the individual level, where the deduction will be capped at $10,000. Then the state tax can be deducted on the federal tax return for the S Corp or the partnership, so that deduction isn't lost. You may want to consider moving profitable 1040 real estate rentals to a partnership to take advantage of the PTE state tax deduction. Of course, it could only be a partnership if there's more than one owner. So like if husband and wife own the property, it could be a partnership. Though you should consider if it makes sense to do that in your situation. A separate tax return will need to be filed. Another option is you could also consider moving a profitable Schedule C sole proprietorship. If you have a sole business, you could move it to an S Corp to take advantage of this PTE state tax deduction and to save on self-employment tax. though there are several considerations to think about in doing that as well. Again, separate tax return would need to be filed. Payroll will need to be set up for owner compensation, and it may create basis issues. This is really not a one size fits all. And last but not least, make sure your tax withholdings and estimated tax payments are up to date and as accurate as possible. Consider changes to tax withholdings of wages, IRAs, pensions, annuities, and even Social Security benefits instead of estimating tax payments, doing estimated tax payments. It's usually more efficient to do it this way. And avoid underpayment of estimated tax penalties. You will be penalized if tax payments for the year are less than the lesser of 90% of tax for the current year or 100% of the prior year's tax. And it's 110% if the prior year adjusted gross income was over $150,000 for a married couple or $75,000 for a single taxpayer. There is no penalty if the tax owed is less than $1,000, and payments are to be made in 4 equal quarterly installments to avoid penalty. Even if the total payments are enough, a penalty may still be charged if 1/4 of that required amount is not paid each quarter. You should also avoid over withholding or overpaying. Consider the time value of money. Instead of paying too much up front, you could save it, invest it, and collect interest until the tax is actually due. Now, a lot of people like to over contribute because they like getting that refund back at the end of the year. So like I said, this isn't a one size fits all strategy for everybody. Think about what's going to be best for you, but it is a good way to possibly avoid losing money. Like I said, those are just a few tax planning strategies. Please remember, these are not one size fits all. There may be reasons why one of these strategies won't be the most beneficial to you. And it's always best to reach out to your tax advisor for planning for your unique situation.
Thanks, Emilee. Thank you, Doug. So now we're going to have Kyle Banks, who's also an advisor with PKS, to see if there's any questions. Any questions out there?
Hey, Gigi, no questions have been posed at this time. Just as a reminder to all of our attendees, if you do have a question, please utilize the Q&A button that should be towards the bottom of your Zoom window. So I'll allow a few minutes just in case anyone does have any questions to use that feature.
Okay. With that said, Doug and Emilee pointed out really good thoughts on, making sure that your estate is in line with your wishes and that your documents are all up to date. And Doug really pointed out a good thing about where to store them. Like Doug said, one of the best things you could do is be considerate of your heirs and your loved ones to make it as easy on them as possible. And then Emilee really appreciated that she pointed it out, that it's not all one size fits all for every tax situation, that you really need to consult your tax advisor to see what will work for you. I've posted our information up here. You can reach out to us if you have any follow-up questions after the webinar is over. You can also find the recorded version if you want to share it with anyone you know that might benefit from on our website, posted after the recording ends. So if there's no questions at this time, we'll go ahead and end it, and I hope you guys have a great day.